Yes, we're live. Hello, hello, hello. Good morning, good morning, good morning. Welcome to another episode of Money Matters. My name is Nev, and this is the show that will answer some of the questions or maybe confuse you by the end of it. Today is Thursday. As on Thursdays, as you know, we do real estate report and look what's going on in the market. So, what is happening inside the market? Well, we're going to be taking a look at the new technologies that are developing in the space of real estate. We are going to take a look at what some of the CEOs within the space are saying when it comes to 2021, what to expect. Is the market going to crash completely and obliterate everything? Or are we going to basically pull through this with minor scrapes and bruises? Or is it going to be completely beautiful, sunshiny weather with rainbows and unicorns? We're going to be taking a look, of course, what's happening with LIBOR, some of the finance companies that are within the real estate space, and looking at basically market overall of what you can expect if you're looking for ways to actually make money and preserve your wealth in the world of real estate. All right, y'all, let's do this. And good morning and welcome. So, as you know, it is Thursday, and on Thursdays, we always cover real estate unless something major happens somewhere else, and nothing major really happens somewhere else that I know of. But maybe you know better. So, hey, I do want to welcome everybody who is watching this live. Hello, hello. Feel free to say hello in the chat if you want to. If you're brand new to the channel, hey, feel free to subscribe. If you want to get notified, well, you know what to do on YouTube. If you're watching this elsewhere, well, then look around, see what notifications exist, what ways to subscribe exist, and that way you'll get keeping on track with what's happening when we release a new episode, which is, well, just about every single day, unless something is happening, and I might have some news at the end of what's happening for the weekend, so we might not have a show. There, I said it. I broke the rule. You're not supposed to say that till the end, Nev, and now you said it at the beginning. I also want to welcome everybody who is listening to this on one of the podcasting services. Thank you so much. This show is not going to have many graphs whatsoever. Well, maybe one, but I'll do my best to explain of what's happening. So as you can see over here on the screen, for those of you that are watching, LIBOR is being phased out in 2021. Now what? We've already talked about that inside this channel, and we've been discussing that. But now we're going to focus specifically on LIBOR when it comes to real estate and mortgages. As you know, vast majority of individuals, when they go out there to shop for their homes, they don't pay cash. So, some do, but vast majority of people don't. And so what they need is, well, mortgage. So if you're looking for a 30-year fixed or 15-year fixed, you don't have to worry about any of this stuff because it is going to stay as is. Like once you get locked into the rate, you get locked into the rate. The challenge comes in if you're shopping for adjustable rate mortgage, or as I like to call them, an arm and a leg. So we're going to take a look into what's happening there. The end of LIBOR is set to phase out at the end of 2021, and it's commonly used in setting interest rates for many adjustable rate consumer financial products, and its end will affect adjustable and variable rate loans, reverse mortgages, credit cards, home equity loans, and adjustable rate mortgages, of course, if they're following LIBOR. If they're following some other index, then that should be pretty much fine. Now, the replacement is the Secured Overnight Financing Rate, or SOFR, index, right? So that's the alternative that is being recommended by the committee. It's being supported and endorsed by the New York Fed. And of course, that's kind of where the direction seems to be going for this market. Freddie Mac began officially purchasing SOFR-based floating rate mortgages in October of 2020. And of course, they will cease all LIBOR index loan purchases by the end of the year. So they are definitely getting out of the market. Now, what also is this interesting piece is that with the purchase of SOFR index loans gaining momentum, they are also starting to offer first tranches of SOFR bonds backed, not baked, not banked, backed by SOFR collateral. So that's one thing that is interesting to kind of see. And, as some of the folks are looking to short the market through purchasing some of these bonds or selling them or, buying them short or whatnot, SOFR is going to be the new way to go. Now, SOFR is based purely on transaction overnight rate data, and because it's much more transactional, it's much more volatile. That's something that you need to understand. And the interesting piece for all of us watching this and listening to this and paying attention to this is that, well, it is also going to be your rate, what you get is going to be fluctuating much more. So, one of the things that is interesting with mortgages is that they're not necessarily adjusted on daily or monthly basis. They are adjusted on annual, and of course, depending on what you get, they might adjust every year, after set amount of time, and like depends on just what product you actually end up getting. Well, using SOFR, they're getting away. The lenders are getting away from the 7-1 arm, and they're getting into 7-6 arm. Well, what does that mean? Using SOFR, institutions are employing the use of 7-6 arms, which reset every 6 months, but are much more relaxed than a 7-1 LIBOR arm. This is kind of interesting piece. So they used an example in saying, well, if it's a 7-6 arm and had a lifetime cap of 4% and it started at 3%, the arm interest rate would never go beyond 7% regardless of what happened in the market. Now, 7% mortgage may not sound all that. Whoa, sorry about that. I'm not quite sure what just happened. Hold on. What happened? What happened? Who cried? All right, there we go. That's what happened. Nev clicked the wrong button. My apologies for that. Long story short, I can't really see the screen. I mean, I can see. It's just the screen doesn't look all that pretty right now, so I can't read it. So I'm trying to over here press buttons without knowing what I'm doing. So let's just say it's a good thing I'm not flying a plane today. But the interesting piece is that while 7% interest rate, historically speaking, is not that big of a deal, in today's day and age, it is, because rates are sub 3. In some instances, they're sub 2. And so, if you are paying 2% on $100,000, that's a very different amount of money that you're paying than 7% on $100,000. Because real estate, we're not dealing with pennies and dollars and tens of dollars. We're dealing with tens of thousands, sometimes hundreds of thousands of dollars. And I assure you that every single percentage point matters, and it matters a lot. And it could make a difference between you being able to easily afford your mortgage or not. So I am not a big fan of the arms or the legs, and that's why I call it, hey, welcome to this financing thing. It's going to cost you only an arm and a leg. But you can keep the firstborn. You can keep the firstborn on this one. So an interesting piece that one of the lenders also had said that we're doing more 7-6 SOFR arms now that the number of 7-1 LIBOR arms we used to do before. Since the SOFR rate is currently much lower than LIBOR rate, this makes interest rates very attractive. The challenge with getting into the arms in today's day and age is how much lower do you expect the interest rates to go? While I do think that we could, and while I do think that it's not completely out of the realm of possibility that we could hit negative mortgages, which we've seen in some European countries, and we've actually covered it. I think we've covered it. I believe Denmark is one of the places. Holland might be another one of the places. So there are a few places in the European Union that do actually give a negative mortgage rate, or a 0%. So some are actually a negative 0.5%, and then there's some at 0, and then there's some at like 0.5%. So when they get to the negative 0.5 mortgage rate, NEV will definitely go back and refinance. But right now, I don't know that that is the case where we're going. So you're taking a large risk if you're getting into the arms and legs. However, of course, the mortgage lenders will say, well, if you are getting into a 30-year fixed rate mortgage, and of course it's traditionally higher than the arms, right? Then you can get into the arm and borrow even more money. And for lenders that make perfect sense, for you as the borrower, it might not be the bestest of the ideas. And I know you don't say bestest, but I think you get the point. Now, speaking of the rates, I do want to actually jump in and take a look at what's happening with the rates right over here. And as you can see, we're tracking a 30-year and a 15-year fixed rates. And you can see that since 2018, we have been steadily going down. There was one little old spike in the early, looks like 2019s maybe, or 2020. And we have come down since very sharply and rapidly. And, here you can actually see something very interesting. I was playing around with this and I wanted to show you. So right now we are looking at the loan purpose as a purchase, credit rating 740 or higher, percent down 20% or higher, location United States, right? And we're looking at 30 and 15-year fixed. Now, if I switch over to refinance, you will see that it resets, but it doesn't reset by much. You will see that the refinance loans are actually much cheaper than purchase, because both 15 and 30 are well below 2.95, whereas the purchase, you can see that they are, and I don't know, maybe they're just changing the scale, but they're not letting us read the whole thing. Now, the interesting piece that I wanted to share with you is that if I change credit rating, for example, right, and I drop down to 680 to 740, we're still between 2.43 and 3.16 on the mortgages. And then if I go to less than 680, you will see again we are between 2.39 and 3.1 something. Again, we're still flirting with the same thing. So it sounds like credit at this very moment is more or less irrelevant. But here's the interesting piece. This is with 20% down or more. Now, if I move that to 5 to 20% down, you will see something very interesting where the rate for a 30-year fixed actually jumps to 3.32, which is still not necessarily bad. And the 15 does stay down right around that 2.4% or something like that. But, and you would expect that if you pay less, right, and we're still at 680 credit rating, and let's see if even if I change it to 680, it drops down somewhat, right? But we're going to play around with this because I wanted to show you something very interesting. If you are at 680 credit and below, and you're looking to purchase, and you can put down 20% down or more, you can expect that you're going to be in the mid to high 2% interest for your mortgage. If you are saying, well, I can do 5 to 20%, still conventional, but you're going to put down, if you're getting for a 30-year, your interest or your jumps to about 3.32. However, here's the interesting piece. If it's less than 5%, we are actually seeing something very interesting, that you are now still at the same amount, and now you actually potentially could qualify for the government sponsored like VA or FHA, and it's going to shift it dramatically. And if we move on up in the credit rating and you're somewhere between 680 and 740 with still less than 5% down, your 15 and 30-year mortgage rates are going to be pretty darn close to each other, which in my humble opinion lets me know that, hey, maybe, just maybe, it might make sense for you. Again, not a financial advice. Nothing I say here is nor should be used as such, and you should never, never, never just listen to me and make your decision on your own, just by listening to me. You got to do your own research. But if 15-year and 30-year cost me the same amount of money, wouldn't it make sense to get a longer loan, because your monthly payment is lower, and if you can still afford to pay on a 15-year schedule, then of course you can do that, right? And you just pay double, and you're going to pay off actually even faster than 15 years by doing that, especially if you're going to be sending, like, say that my mortgage on 30 years is $500, right? And I send $500 every first of the month, because that's when most of the mortgages, at least on the residential side, are due. And then, but I want to sort of pay it off faster. Well, I could get a 15 year, and maybe it's not going to be exact math, but let's say it's going to be $1,000, right? And every month on the first I pay 1,000. Well, you can do the same with a 30-year mortgage and pay it off faster, right? And if you do 500 on the first and 500 on the 15, you have a potential to cut that down to about 10, 11 years, something like that. So you could pay it off way, way, way faster. And here's the cool part about doing it that way, as opposed to just getting a 15-year, because the savings is not that much. You're actually better off with a 30 year, sorry. Because if something was to happen, it's an uncertain economy. We can all agree to that, right? Where your job, maybe you get laid off or furloughed, or maybe you get cut in pay, or whatever ends up happening, you can still stay solvent. You can still stay current without having to go into the forbearance, and you can actually jump in and just pay $500 that you have to stay current, and then when your financial situation improves, you can jump back to the $1,000 anyways. So that's something to kind of think about. Now, one of the things that we did talk about is, I just mentioned the word forbearance. So what's happening in the world of forbearance? Well, new forbearance requests declined this week, and exits show to a new low of the series. Economic recovery that is slowing, and we are seeing that from the job market data from November. And it's not surprising to see the rate of forbearance exits slow as well, because the households that need the forbearance assistance in October may be in an even greater need in November, and likely December through January, February, and maybe even into the March. We'll see. The total number of loans in forbearance extensions gained 77.9% as homeowners chose to take advantage of relief through the past past the initial 6-month term. So they're basically turning over and saying, yes, I will take another 6 months. The forbearance re-entry also rose 2.29%. December marks the next largest volumes of expirations, with more than 1 million, or 39% of active plans currently set to expire, most of which are reaching the 9-month mark. So we still have about 3 months before the first wave of what's going to happen with this large forbearances is coming. Weekly service center calls decreased from the previous week, from 7.7 to 5.3%. Now, this is a nice and big decrease. That basically means that not as many people are calling in for, let me adjust some lighting over here. Not many people are calling to get into the new forbearance, but we're seeing folks entering anyways. Deadline for receiving support has been extended, and requesting forbearance now ends on January 31st, 2021, for loans that are backed by the FHFA, Federal Housing Finance Agency. Those backed by FHA will still have a deadline of December 31st, 2020. So these programs are basically coming to sunset. Again, I know that there's some conversations that are happening right now inside the Congress and that kind of stuff, right? I know that they're having conversations about it, but I think it's a very interesting piece to also know that they haven't decided stuff. So we don't quite know how this is going to, end. There's still conversations. They, of course, have their, Christmas recess, because again, congressmen and women are like 3-year-olds. They have to have their recesses on a very set schedule. Pandemic, economic collapse, and all, they still go on their little breaks. They've done it before earlier in the year. They're going to do it again. And their recess begins in about 8 days. So if they can't agree to much of anything, nothing, absolutely nothing will happen until sometimes in January. And by that point, people might just decide to wait for the new president to be rolled in, right? That January 20th. And then we can expect things to happen. So if we don't see much of anything in the 8 days, don't expect to see much of anything happen until late January, most likely early to mid-February. And by the time that puppy rolls out, it's going to be March or April, or as I like to call it, too little, too late. Now, it's time to talk about mortgage applications and what's going on there, because that lets us know what's happening in the market. So we've seen what's happening with the with the forbearance stuff, right? It's not all that pretty. It's not all that pretty, but it's still, we're still kind of taking on. It should be all right. Applications did decrease 1.2% during the week ending December 4th. And what has happened is that the increase is in refinance application, and it was driven by FHA and VA refinance, while conventional activity fell slightly. A shift in the composition of purchase applications with an increase in government loans pushing the average loan balance lower. So, of course, we're seeing that some of the most vulnerable are starting to enter at the last minute. Part of it is because, well, they were waiting to see kind of what happens. Part of it also has to do that some of these programs didn't roll out some really amazing deals until much later on. They tend to be a bit more on the lagging side of things. But that does also create a bit of a risk, because when we start seeing predominantly jump in the FHA and the VA, that's when typically, not always, but typically we see a bit of the end of the cycle potentially. Again, is it not? I really don't know. My crystal ball broke years ago. I got nothing. I'm just looking at this and looking at historic and saying, what is more likely than not that might have transpired. The FHA share of total applications increased to 9.9%, and the VA share of total applications increased to 12.7%. One thing to keep in mind with FHA and VA as well is that these particular programs are, they offer some of the best ways and easiest ways to get into the market as a whole, because you don't have to put this conventional 10%, 15% plus PMI craziness, or 20% down. You can go in for FHA as low as 3.5%. Of course, if you 3.75, sorry, if you qualify. And on the VA side, you can at times and rather often get in for 0%. Now, I do think that the lower the down payment, the higher the risk, but the higher the risk is typically for lenders. So that's why typically these rates tend to be a bit higher, but they have lowered their rates, which is why I believe right now folks are deciding, wait a minute, I'm going to jump in on this train and play around. Now it's time to take a look at what's happening in the world of real estate and some of the technologies, the financing, and everything else. The first story has to do with Sophie, or SoFi. I don't know how you call it. It's SOFI. And digital lender SoFi, or Sophie, is contemplating an IPO. And they are exploring, they're the latest firm to explore an independent public offering, going through a SPAC in order to do it. SPAC. We've covered this before, and if you don't know what it is, simply go to the YouTube, look up for Money Matters channel, and right there in the history of the things in the last month, maybe month and a half, we have covered what SPACs are. Lender was last valued at 4.8 billion after a funding round last year. It is best known for refinancing student loans. However, this startup also offers a variety of other financial products, including personal loans, small business loans, home equity loans, and mortgages. In 2016, Sophie announced a partnership with Fannie Mae, which includes a new loan option that permitted homeowners to refinance their mortgage at a lower rate and pay down the balance of existing student loan. I didn't cover this on this channel, but I did cover this with some of my friends and students a few years back when this was rolled out. And the cool part was that they would basically allow you to do a refinance, pull the equity from the home, eliminate the student loans. Now, I know in some ways you're like, wait a minute, this is crazy, but it's not. And the reason that it's not is because typically you can get a lower interest on your home than you can do on the student loan. The second part that I think that this is kind of a cool and interesting product, unfortunately not a lot of people are doing it because, well, financial education in schools is not, quite there yet. Maybe it will someday, probably not. But YouTube is, and you can find a lot of things on YouTube these days, or a podcast. So the interesting piece is that the difference is that the student loan debt is basically non-write-offable. If you were to find yourself in really troublesome times and you have to go through bankruptcy, again, for most people that is not like a dream and a goal in life to go through a bankruptcy, but things happen. Life happens. And we find ourselves at times, typically through no fault of our own, at a place where you just can't, you're not solvent, right? You just can't afford to pay of anything. You can't deal with anything. So the beautiful piece that the United States of America offers us is ability to file for bankruptcy and basically stop the calls, stop the insanity, and take all of that stuff away, wipe the slate clean, and allow you to start your life all over again. This decision should never be made lightly. It is not an easy decision. It's not something that I think should be done for like $1,000 or something like that. I mean, I am saying like you are deeply in debt. Stress is overwhelming. You can't start over, and this gives you a breather. This could be a way for you to do pretty much that, right? But it's not for everybody, and you should be talking to your accountants and attorneys and financial planners and really study this if you want to do it. But even if you were to do it, student loans in 99.99% of the cases do not get written off. That stays even after the bankruptcy, and in many cases, even once you pass, the student loan servicer or person holding the notes, right, the promissory note that you sign that you will pay off the money, could be passed on to the heirs, meaning your kid could be on the hook to pay for your education. Most people don't know that, but it is true. So, ability to go in and take your house, right? Buy the house. I'm not saying do anything crazy. Get a lower loan and then pay off that education. That means that if something, heaven forbids, let's knock on the wood, chase it all away, do what you need to do. But if all of that was to happen and you need to go through the bankruptcy, everything is forgotten and forgiven and wiped off, and you can start anew. So again, not like the best of the cases, we're talking like some ugly pictures here, but it gives you options, whereas the other way around does not. So that's one thing I actually kind of liked about this particular thing. Now, Sophie caters mostly to the jumbo market on the mortgage front, and the lender requires a minimum of 10% down on all mortgages, but doesn't require PMI, which is interesting. It also doesn't bake in origination fee, but you have to pay a one-time fee of $1,500 or $1,495 loan processing fee. So this is an interesting piece that is kind of happening and developing there. Now, Sophie doesn't originate government-backed loans, so you can't do the FHA and VA with them, but they do offer conforming conventional loans. If it ends up going SPAC route, it will follow two other mortgage lenders who chose the investment vehicle. United Wholesale Mortgage, which we've covered last week. They're the guys, UWM, they're the guys that are offering that sub 1% mortgages. And Blackstone owned Finance of America, which are both expected to go public in the next few months. The company said it had recently received preliminary conditional approval from the Office of Controller of Currency to establish a national bank charter, and branched out also into the stock trading and cash management accounts. So as you can see, it started as a small, school loan lender, and it ballooned into, I don't want to call it a giant, but they have ballooned and expanded into many other opportunities and sections. Now, the interesting thing is when we're talking about the startup and different things of what's happening, let's go in and talk about Knock. Knock. They're launching a new sale leaseback solution for individuals and residential. Now, we've had some of these companies that do this stuff. We've covered it a few months back, maybe a month back, something like that. But we did talk about some of them. Here is the new one that is coming in. And I know that many of times they will say this is for your good, but I assure you they're doing this because there's a market there and they are looking to profit. Now, these types of options used to be only available on large commercial real estate properties, and we've seen in 2008 downfall, crash, recession, blow up, however you want to call it, that many government offices were basically done the whole sale and leaseback. Real estate technology company Knock has announced the launch of Knock Nest, a standalone sale leaseback solution that allows homeowners to access the cash they have built up in their home while continuing to live with it. And no, it's not refinance, it's not HELOC, it's basically you request a no obligation cash offer for the home, allowing to pay off the mortgage and access equity in about 2 weeks if individuals qualify. Then Knox basically purchases your home and rents it right back to you. Now, you can actually rent it back for 1 year, 2 year, and then you have an option to continue and renew the lease, or you can repurchase the home, or I guess you can just always move out. For most people, their home is their single largest asset, and over 97% of homeowners have positive equity in their home. So what this does is allow for individuals to pull the money out, but it also allows for NOC to know that, hey, we can offer some money. Folks have a still place to live. We get a really good deal, and then we get a monthly cash flow. This is very interesting and very, very cool. And of course, it is currently available in select cities in Arizona, Colorado, Florida, Georgia, and Texas. You might want to remember these states because I have another piece of news when it comes to real estate technology that might involve some or vast majority of these. So hopefully you remember them, and if not, you can always rewind, I guess. Real estate tech startup roundup. Well, we have a few different companies, startup companies within the real estate space. Residential real estate online marketplace HouseX has announced the launch of its smart home marketplace and pilot program, and it's available in California, Florida, Georgia, and Texas. I promised that they would repeat. Hopefully you remember. HouseX showcases over 30,000 new energy efficient smart homes with over 10,000 available for quick move-in. HouseX only represents the buyer and aims to decrease the cost to own, operate, protect, and maintain a home over time. It offers incentives including a 1% discount mortgage for the first 12 months of a special 30-year fixed rate mortgage. Now, when you see this, it's going to be a one-time discount for the first 12 months, and then after that, it's going to adjust on upward, something for you to note. But hey, if you were going to buy it anyways and the price was right anyways, saving a little bit of money might not be the worst thing on the planet. It is very interesting that many of these startup companies are targeting very specific markets, and you will see that Florida, Georgia, Texas seem to be appearing as well as California. So that's kind of an interesting piece. Now, the second company is a real estate technology company called Co-Home, and has launched a new platform that allows users to invest in real estate by matching qualified buyers through co-buying, a process where two or more people purchase a property and agree to share ownership. It connects pre-screened qualified buyers and sellers with each other. It's a very interesting concept. And then the final company is Boomtown. Boom, not Boom, Boom, B-O-O-M, as in mom, town. Boomtown, a real estate sales and marketing platform, so this is more for the agency side of the whole spectrum, has announced its integration with Sisu, or Sisu, S-I-S-U, a performance management and business intelligence platform. Users can create real-time performance leaderboards and other productivity tools, and integration is available to Boomtown clients at no cost and allows users to bidirectionally sync their leads, agent activities, and transactional data. And again, that's more for the agency side of the things. This is pretty cool, and it's always lovely to see a development happening inside real estate. It is one of the places, as you might know, that I too am working on developing. And knock on wood again, since we've been knocking on wood earlier, we should be hopefully having some stuff happening. The cool piece is we're going to be utilizing some of the modern technology to assist you, and I'm really, really excited about where we are and what's happening. We should be, honestly, days away, maybe weeks away from the launch. I keep saying that, and then, things end up blowing up and something happens with the computer code, and then we got to go fix it, and I'm like, I can't release it now. So, but it should be coming in, and the cool part is it's going to do something similar to Co-Home. If you want to do it that way, you don't have to. It's going to do something similar that Zillow does, but not exactly. It's going to do something similar with some of the specs are doing, but not exactly. So it's going to have a lot of components of a lot of the other companies, but it's going to give you the chance to be in a full control of everything that happens, including the full ownership sale and everything else that you might want to do. Final piece to wrap up today's super exciting episode is what to expect when the forbearance ends, right? We know that this is coming. We are saying that, hey, we're entering 9 month now in December, which means, by March, we're going to start having first wave of these folks in forbearance that cannot renew anymore, pending that the new laws don't end up being developed in January, February timeline, right? So what can we expect? And for this, we actually have an interview with Redfin's Daryl Fairweather to find out of what is going on and what she thinks. And I actually agree with many things that she's saying. So I'm going to stop yapping and I'm going to let the ladies take on the show. Three, two, one, let's go.
My question for you is, what are the main differences between the 2010 market and the 2020 market? What are the current average loan to value ratios?
The the big thing to know about the housing crash of 2008, 2009, 2010 was that it was overvaluation in the housing market that caused the recession. And most of the impacts of that recession, therefore, impacted the housing market much more strongly. So the difference now is that the housing market is not overvalued. The reason that home prices are rising is because there's less supply than there is demand, and that's pushing up prices. We're not at risk of any bubble bursting because I don't believe there is a bubble. What happened before was that home prices started to drop. People realized that their homes weren't worth as much as they were, which caused prices to drop even more. And it was a snowball effect. And people were in this mentality before where they thought home prices would keep going up. They never stop rising. So they kept taking money out of their homes and they kind of used it as a piggy bank because they just thought there wasn't any risk to taking money out because home prices would just go up and they make that money back. So we've learned a lot of lessons since then. Lending standards have got much stricter. People are much smarter about taking out too much equity from their home. So there's just a lot more fundamental strength in the housing market than there was back then.
All right, thank you for answering that. Now let's talk about a quote in this report that I think is truly interesting. In the report, you say American homeowners have gained $2 trillion in home equity since the beginning of the pandemic alone. And thanks to double-digit price growth and strong home buyer demand, the supply of homes for sale has now fallen to historic lows. That being said, you claim an impending wave of foreclosed homes will only make a small dent in the inventory drought, as first-time homebuyers and investors are likely and quickly to buy up any foreclosed homes, leaving the larger housing market unimpacted. Personally, I believe this highlights the struggle the average American homeowner may be facing currently. But in your own opinion, what does this say about the market at large?
So there's more people who want to buy homes right now than there are homes for sale. And there are also plenty of investors out there who see the strength of the housing market and also want to get into it. So when there's an increase in foreclosures, which I do think will happen. I mean, we have this big pause in a time where you can have a foreclosed home. So there will just be a delay and a big increase because there's been this pause on the market. There's also been a pause on people buying up foreclosed homes. So while there will be an increase in foreclosures, there'll also be an increase in people wanting to buy those. And there are two groups of people who buy foreclosed homes. There are the investors who are looking to take a distressed property, flip it, improve it, and sell it again. And there are some people, first-time home buyers, oftentimes, who are looking to get a really good deal on an affordable home that just needs some sweat equity put into it. So both those groups are going to be eager to buy because there really haven't been many listings of affordably priced homes during the pandemic. The people who have been listing are people who are more affluent, who feel more economically secure. The affordable home market has also kind of been on pause because of forbearance itself. People who own affordably priced homes don't feel pressure to sell yet. And that's been putting a pause on the affordable price market too. So there's been a pause on both demand and supply, and I think they'll both resume after the pandemic ends and after forbearance ends.
Well, there you go. She's saying the same thing that I have been saying for a little while. Don't get the rest of the, folks over on the YouTube trying to petrify the daylights out of you that something bad is coming. Of course, We could see it. Nobody has a crystal ball. Nobody knows exactly what's going on. But one of the things that I believe we can expect reasonably is to understand that, hey, while yes, it is possible that things could tumble down, many people out there within the space, myself included, are not really seeing it, because this is one of those things that, there are many people on the sidelines waiting for this to happen to basically pounce on it. So that's number one. That means as foreclosures start to actually start increasing and showing up, more and more people are going to start jumping on that train and buying things up, meaning the prices are not going to dip as deeply as we might have originally been led to believe. Again, I could be wrong, but that's kind of how I see it. I do agree with her that it's a very different market now than it was in 2007 and 8, and it's also very different of, many people didn't see 2008 coming, whereas it's still relatively recent in our memory. And so of course, because it's relatively recent, many people are still paying attention to it and are banking on it, waiting to actually buy it. There's some other analysts within the space that are also saying we have way more buyers ready to jump when the foreclosures start going on up, then we have, the leads for the foreclosures. So I think overall we are looking at a pretty okay market in the upcoming months. Now, yes, is it possible that the prices might slow down and come down a little bit? Yes, and I actually think that would be lovely. Are we going to see some more affordable prices get into the market? Yes, I think that that's going to happen. And again, I think that that's going to be very, very lovely. So overall, I am still very, very positive, very bullish, long term on real estate. And, all these companies that we just been talking about, building on the tech side of real estate, myself included, we wouldn't be throwing in all this money into the space if we thought the space is going to die in the near future. And for many of the projects that we just talked about today, we have some incredibly prominent investors that are backing those deals, that are backing those projects and startups. And so, of course, they too wouldn't be risking quite a bit of their money if they didn't believe that this space has an ability to deliver over the both short and especially long term. If you are a somebody who is going in and trying to kind of make some quick money, I don't know that real estate is necessarily the best thing. You might want to try DeFi, although you could also quickly lose the money, so pay attention to that. But real estate is more for a long-term play, long-term gain, and if you're ready and willing to do that, then it could and it does have a potential to actually do some incredible things for your wealth and money. So there you go. That's it for today. Thank you so much for watching and for listening. If you're new, again, do me a favor and do subscribe. And I will see you not tomorrow. I was going to say tomorrow, but not tomorrow. This weekend, Nev has to go and work on some projects, so I'm not going to be around to be able to do some shows. But we will be back on Monday. So we're going to take a couple of day breather, but we'll be back on Monday. And who knows, I might do some other recordings and stuff in the meantime and put it in and kind of drop it, and you might still have some videos on the channel, but it's not going to be live. So until then, stay forever money blessed, and do remember,